Up next, we have a panel that's all about money. How many of you are looking for money in the room? That's it? So you're all like profitable? I highly doubt it. So we're going to do a panel all about what we call the Series A crunch. We've seen in the news a lot of articles talking a lot about how startups are getting funded by these so-called super angels and this money is flowing like water. But the minute they get time to raise their Series A, they hit a wall. So let's find out if this is for real. I'm going to bring onto stage, one at a time, the following panelists, and will be followed by your moderator. The first panelist we have is Miura-Ko. She is the partner at FLOODGATE. Anne, please join us on the stage. Following Anne, we have Christine Herron. She is one of the directors of Intel Capital. Both Anne and Christine have been a part of the Women 2.0 community in a big way for many, many years, so thanks to both of you for always supporting us. Next up, we have Freada Kapor Klein, who is a partner at not only Kapor Capital, but is also the co-founder of Level Playing Institute. Freada, please join us on stage. And only because we needed to finally bring a man on stage, really for no other reason. He is not really qualified to even be on stage at all. I've never even met him, let's be honest. Scott Kapor, I don't know if I said that right, but Scott, please join us. He's a managing director at probably one of the, I don't know, poorly funded venture capital firms called Andreessen Horowitz. So Scott, thank you for joining us and for putting up with my humor. If you don't already know, the winner of the final of the Pitch San Francisco competition tonight, the winner will get a meeting with Mark Andreessen, because Mark has so much time for us, right? So thank you for making that happen. I appreciate that. Last but not least, yes, it seems like there's a trend here. We do bring on Canadians to stage. Sukhinder Singh Cassidy, please join us on stage. She is the founder and chairwoman of Joyus, and she is your moderator. Oh, I love your jacket. With that, the mic is yours.
Okay, great. Thank you, Charrose, and welcome, everyone. So we're going to do this a little differently. I understand there are a lot of questions in the audience, so I'm going to try and keep our panel actually very short. One question per panelist, and I think one round-up question, and then we're going to go straight to audience, because I think if there is a lot of kind of appetite for asking questions, I want to make sure we have time for it. So I'll try and keep us moving fast. So first of all, maybe we could pull up the slide, Charrose, that I'd sent to kick off our panel. Hopefully it'll be up in a second. So the first question is sort of, is there a Series A crunch, right? Everybody's asking this question. And so I went out and did my own research looking across the web. And I thought this slide, if we can get it back up, sort of to me demonstrated sort of factually what might be going on, which is in fact, you know, if you look at Series A funding, it's doubled since 2008. So we've gone from 118 to 244 financings of angel or seed companies, events, according to PitchBook. But when you look at the ramp of angel-funded companies, right, or seed-funded companies, that has quadrupled. So there is absolute increases in the amount of Series A dollars available. There is a relative crunch, right, so to speak. And I think that's what we're here to address today. So I'm going to kick it off, actually, with you, Scott. We've never met either, but I thought, why not put a guy in the hot seat first? So look, if you know, to get straight to the point here, when you think about that chart, right, what do you think are the key implications for those people looking to raise? And if you were to sort of start off with, what are the things that entrepreneurs need to think about doing differently or doing to differentiate themselves in order to sort of compete with, effectively, a larger pool?
Yeah. So it's a great question. I would start off by saying, first of all, I think I agree with everything in that chart. I think that chart is actually really a positive thing, not a negative thing. Mm-hmm. What that says to me is there's a tremendous amount of experimentation and innovation actually happening. And yes, the reality is all those companies probably can't get A-round financing. I think that's probably true. But some of that is a function of just supply of capital. Some of that is probably a function more of just technology adoption cycles, right? It takes a while for consumers to be able to actually adopt technology en masse, and we've had a great financing. So I think it's actually a very positive thing for the industry. Seed capital is only about 2% of the total capital in the venture business, and so I don't think it has massive implications for overall, VCs being interested in funding companies, even if a significant portion of those don't get funded. But I think the critical thing people have to do is what I think people have always done in this business, which is you've got to have breakthrough ideas, you've got to actually have demonstrated traction, and this is a relatively efficient business in my mind. For businesses that show that, there is still tremendous interest from the VC side. Last year, just to give you a perspective, right, $28 billion got invested in companies last year, so I don't see any sign of slowdown in venture investment, despite the fact that obviously there's been a lot of uptake on the seed side.
Would it be fair to say, though, that you identified rightly that, look, a lot of companies can get started, but there is also just maybe an absolute curve to customer adoption, and there is an absolute, for lack of a better word, traction bar in order to get a Series A raise, right? So when you say traction, can you be more specific? With regard to, obviously we have consumer companies, we have B2B, but gross generalities here. We've got sort of what you would call media-driven models, which are largely engagement and then find your monetization.
Right.
And then we've got what you would call experience equals monetization, which is largely subscription models and e-commerce.
Yeah.
So can you give me some more defining characteristics of traction for a Series A
Yeah, I think
round?
the big thing, for example, when we're looking at a Series A, particularly on the consumer side, right, is there's two metrics in most cases you care about. Obviously, one is just raw user growth, and you can tend to see once you kind of look at some of the numbers, obviously, where you see growth curves growing. The biggest thing I think that people miss, and we spend a lot of time on, is what's the actual engagement and the abandonment rate of those customers. And so the things that we like to dig on are show us a cohort analysis. Let us see over the last 6 months, what's happened to customers who joined 6 months ago. What's the engagement look like over time? Because ultimately, those are the monikers of things that will actually drive monetization for the thing. So we're willing to make a bet that monetization may come in the future if we think the customer base has the characteristics that lend itself well to monetization.
Got it. So is it fair to say that while you care about absolute user growth, for you, engagement and churn, so a smaller cohort done well is better than sort of everybody can show their numbers are up and to the right on
I think that's right.
acquisition.
Because you're talking about there's so many risks you're going to take on the financing side here, and the more things you can mitigate and say, okay, at least I believe, yes, if they actually get to scale, there is a monetization model that makes sense for this business, and at least there's enough history now of understanding that. So the real question is, do they have enough engaged customer base with at least, albeit a small cohort, to believe that those people will actually spend money once we introduce a monetization model?
Okay. All right, so moving to one other part of what's happened in this cycle that we see, right? One other part of what's happening is convertible funding has exploded. I mean, generally speaking, I'm also an e-commerce investor in addition to being an entrepreneur, and I cannot tell you the number of pitches I got in the last 18 months of like, hey, Sukhinder, I'm doing an uncapped convertible note. Do you want to participate? And I'm like, what's the size of it? And they're like, $3.5 million, on its way up. And I'm like, that's a damn big convertible note. But so just stepping back for a moment. So when you all think about sort of the environment we had where there was a lot of convertible note funding, generally, which I don't know if it's at the peak it was at, generally a good thing or a bad thing? Has it exacerbated this issue in a positive or negative way? Christine?
Yeah, I don't like it at all.
Okay. All right.
So let's not pretend I don't have an opinion. So I generally don't think convertible notes are a good way to align interests between entrepreneurs and investors. If someone has a capped note, you basically set up a situation where the entrepreneur wants to beat the cap, and the investor wants you to be below the cap. Right, because I am not going to know what my cost is until ultimately you actually convert me. Right. So that's sort of an awkward situation, whereas if you have equity, everyone's on the same side of the table. I also think that by doing notes, you've made it easier for people to kind of keep dribbing and drabbing money into the company, and I think entrepreneurs, you end up spending a lot more time fundraising over time, as versus doing it all in maybe one big effort. It is nice that first money does come in very quickly, and that part is great. And if you're raising a very small amount of capital, that's absolutely the right thing to do. But if you're raising multi-millions of dollars as a note, you have some issues about your incentives. I think you have some issues around your focus and are you fundraising, because you always could take a little more cash. Or then I think when it's time to then finally convert, you start to have what we think of as an overhang, right? So you have this overhang issue where, and this is not a rule by any sense, it's just, I know it's a guideline I think a lot of people have, is I don't want to see more than, say, a third of any given round be a note that's flipping in. So if you raise $1 million note, that means when you convert it, I want to see that you're at least having $2 million of new cash come in. And so you're going to set a valuation based on a $3 million coming in as the equity. So I think when you do these multi-million-dollar notes and then it's time to actually price that out and raise new cash, you're like, so if you raised a $4 million note, like how big is that round going to be so that the note isn't sort of overhanging the new cash in a way that the new investor won't like. So I think it can create some issues. But, the 500,000 note, sure. That makes sense.
So
it's
size,
the big ones.
size is the key.
Yeah, size does matter.
Got it.
Had to be said.
I'm going to turn my attention to Anne for a second. Because one of the other debates that's happened is companies have started to feel this crunch, right? Is also looking back and saying, does it matter who you raise your angel money from? And so obviously, we've got the pros and cons of raising from a VC and a seed. Is that a good or a bad thing? What happens if they follow or don't follow on and do your A? Now, what about the super angels? What about the band of individual angels? Are there worse or better seed investors for the environment you're in when you're seeking to do an A? So, Anne, pros and cons of kind of who actually does your seed.
We like to say.
Is it on?
Hello?
Check it.
I swear it's on top. Oh, here I go. There I go.
There
Hello?
you go.
Oh, there we go. Okay. So, I'd like to believe that who invests matters at the seed stage because I invest at the seed stage. But I do think that as you need to be heard above the noise, having someone be on the hook for actually your success in raising your next round of financing can actually be very, very critical. And so, as Floodgate, we actually like to say we are the lead investor in the round. We don't say we're the co-lead where we share responsibility or we're just a passive investor. We really like to say we're on the hook. And what that means is if times get really tough, we're on the hook to help you. If you're having a tough time raising capital, we're on the hook to help you. And we will actually vouch for you as a company when you're going out for your next round of financing. And I think, as Scott was pointing out, one of the really important things in your Series A financing is it's just sort of like college applications today, right? It's like all these kids are really, really qualified. They do research at Stanford. They did, hundreds of hours of community service. And then it's sort of like, well, what do you do? And so I'm a mom to a 6, 3, and 1-year-old. I say, you have to be more awesome. And I think it's the same thing for, seed stage investments is you have to be more awesome. And one of the ways in which you can be more awesome is, having investors who will vouch for you, but also at the seed stage level, help you understand what it takes to raise that Series A and level set your expectations and make sure that the dollars that you have today will last until that point where you've actually proved out those milestones so that the Andreessen Horowitz will look at it and say, oh, this is an interesting company. We have enough track record where we know that's what it takes to get that Series A financing.
So would that run, would that run contradictory or counter to, sometimes people feel when they're raising money from individuals, gosh, I've got to get every awesome, well-known individual angel in the Valley to invest in my deal. So you have 15 people in a deal, and each of them has put in $50,000 or $100,000, and they're all individually awesome. They're all well-known people in the Valley. And a lot of people spend their time constructing that portfolio of seed investors versus one large lead investor, right? Call it a super angel or what have you. So
I don't think they're actually they run counter to one another. So as a seed investor, we also believe that it's important to leave aside a certain amount of financing for what we call the Ocean's 11 or Ocean's 12 set of angel investors, right? And so in Ocean's 11, you had the guy who was like really good at avoiding the laser beams, and then you had the person who was really good at the locks. Well, we believe that angel investors bring that, right? And so what we're looking for is when we talk to a founder that we're investing in, we say, what is your dream team, right? Let's just talk blank slate. What's your dream team? And having that slug of capital from angel investors, we think is very important. But that doesn't mean that you don't take someone who is actually in charge of that financing round. I think that is important.
Right, but the construct is a combo construct where you think about somebody with enough skin in the game to push you into that next round with all of their might, right? That's one of the key pieces here. Plus the construct of the dream team behind you.
Right.
So, Christine, well, I'm trying to decide who to ask a question about the benefits and cons of putting a VC in your seed round. Maybe, Freada, I will start with you, given that you are the non-institutional investor.
Great.
So, putting a VC in your seed round, yes or no?
Present company accepted.
Plug your ears, guys.
Look, and this came up at the mentoring lunch too. Be really thoughtful about who your investors are at each stage along the way. What are you looking for? What are your values? Who's going to help you build the company that you're going to be proud of? And who's done what to help you along that path? So sometimes the dream team is about known names, and it's not about who the people are, who they know, and how that's aligned to the business you're founding. So we're increasingly focusing on social impact. So we want the team of investors, and we want the founding team to reflect your customer base. So if you're an ed tech company and you think you want to develop the world's best STEM app for low-income kids, and you're all a bunch of white guys, present company accepted, you're all a bunch of white guys who went to private schools your whole lives, it's like, really? So there's a profile in the abstract, and then there's a profile in the actual company you're building.
Okay. So I've got two more questions before we turn it to the audience. As I said, I want to leave lots of time for everyone here. And this one, I think I'm going to pose both these questions to all of you because I think they're interesting. So one of the key things I think nobody talks about, but I think is worthy of discussion given some of what we're seeing is, should every entrepreneur, in fact, raise a Series A? There's a sense when you're an entrepreneur that you are on a path, right? And you're on the path from seed to A to B, B to C, C to D. And at some point, that train is going, and God damn it, you're going with it, right? But I think the real question, I think one of the questions here is, should every entrepreneur want to raise an A? And what do you all think are the disciplined questions you need to ask yourself as an entrepreneur when making the decision about whether, in fact, you really should take your company to that stage?
I'll start if that's okay. So, and I literally had this conversation yesterday with a company. I mean, I think the answer is it depends, right? So it depends on what you want. So there are wonderful things about taking money from people on this panel, and there are horrible things about it, right? You now have a new set of bosses, you have a new set of expectations, and, you know, like it or not, we are investing in companies where we think there is a tremendous growth opportunity, and if you're not signed up for that as a management team, it's really, it's not a good place to be. So just to give you an example, I was talking to this group yesterday, which is actually in the telecommunications business, and they have a very nice business. They've got a $5 million business. They've bootstrapped on their own. They've never taken outside capital, and they're at this juncture where they're saying, gee, do we want to do that, or we could continue to kind of grow this, and it'll be probably $10 million next year and $15 million next year, and it's really I think it's a heartfelt decision they have to make, which is, what do they want this thing to look like over the next 5 or 10 years? And what they were saying to me, which I thought was interesting, was they said, look, we think we have a 2 or 3 year head start, but we think this is a big opportunity and there's going to be lots of people coming in, and what we really want is to be the #1 business in the space. And I said, look, in that case, I think, you know, raising capital probably makes sense as long as you understand that. But, you know, there's a perfectly normal and reasonable other path that they could go down, which is just continue to bootstrap this business. And, you know, I think it's a real critical juncture. And I think the answer is no. Not everybody should raise a Series A if it's not what you want.
And I mean, to be honest, you've described the nirvana scenario, which is an entrepreneur gets to $5 million in revenue, you know, with no external funding, and is trying to decide whether to stay cash flow funded or take capital. The vast majority, I think, of people contemplating the question of a seed to an A is it working?
Yeah.
Is it working well enough? I could get capital. Should I take it? Am I ready to be on this journey? So I would love the rest of you to focus, if you could, on that question, because I think it's often not obvious when you started a company. Let's face it, most companies don't get built in their seed stage. So you have some signals of success, some signals of failure, a harder environment, and the real questions about sort of, you know, you're at this fork in the road, right? Once you take A capital, again, you sort of are committed for 2 more years, and on you go. So in the case where it's not clear if you're succeeding or not, you know, how do you know if you should, in fact, move your company to the next level?
Well, I mean, I think you're sort of buried in that question is like, do you actually have cash in the business or not? So if you are running a business and things are going well, you think it could be large, but you don't have revenue or it's not breaking even yet, then yes, you need to raise more capital.
Yeah, of course.
Or else, you know, you're shutting the doors down, so you're making a very binary decision. So you've certainly got that. I think there's this question I think a lot of people don't realize, and I've been surprised that some, for first time or early entrepreneurs, don't realize it, is if you've raised convertible notes, you don't have to convert them, right? They can be debt that you pay back. You have this option before you, more branches on the tree. Once you raise equity, you must sell your business someday. Someday that won't be yours anymore. And maybe you'll go public, and there's that little slim set of companies that will go public. More likely you'll sell it. And it's been surprising that people don't realize you raise money, you're selling your company someday, and you have to sign up for that so that we get our money back out. This is not a restaurant.
Whether you want to be in it or not.
Yeah, it's not a restaurant where I just want to come eat at the place. So you have to figure that out, and if you're signed up to build that kind of large scale, you do the exit, you go start the next one, or maybe you grow it, as part of a merged or larger entity someday, then yeah, raise some more money. Go ahead, go grab for that brass ring. But if you just want to run that business and you don't necessarily want to go shoot for an exit, then you might want to think about, how do I do this without raising equity capital that I then have to return to someone someday? And maybe that's debt. Maybe do some more notes with angels. I don't mind, more modest return than we're paid to go find. So.
I think what I would add to that is, in any given year, there's really 12 to 15 companies that are valued at over $500 million at exit. And if you're raising your Series A, that's what you're signing up for. You are one of the top 12 to 15 companies in any given year, because typically you're raising a Series A from a fund that has more than $100 million in their fund. And so their economics are such that if you exit at $100 million, is that a great exit for them? Probably not. I mean, they're okay with it, but they're not really excited. They get excited when you hit $500 million or more. And so if you're at a stage where you're really unsure, going down that path can be pretty dangerous. And so, if you're running out of cash and it's sort of an existence question, then maybe you have to go down that path. But even then, there's sort of this question you need to ask yourself, given what you know now, do you still believe that you could be one of the top 10 to 15 companies in any given year?
I would also say, in addition to that, if you put yourself in that top tier and that is what you're signing up for, and you are signing up for an exit, do you know who you've taken the money from well enough that they're not going to toss you out and bring in another set of professional managers? Because the frequency with which that happens, and given that this is Women 2.0, given all of the additional subtle and not so subtle biases and barriers that are in the paths of people, if you don't look like anybody that firm has ever given Series A money to, I think you want to think twice and 3 times and 100 times about your own future and whether they are committed to letting you stay running that business.
I think the last thing I would add, and sorry, I know I'm the moderator, but I think this is an important question, and I'm surprised. I know I'm not supposed to give my own opinion. But I'm surprised it doesn't come up for any of you, is the question of introspection, honestly, because you all sort of propose, like, okay, you're going for it or you're not. But I think for me, one of the bigger subtleties, and I certainly faced it when I decided to start a company, right? My official title now was CEO, but through my seed round, I told my angels, I'm not taking the CEO title. I'm going to take the chairman title because I want to reserve the right to go hire a CEO for Joyus, right? I don't think that's what's going to happen. And I literally refused to take the title because I was like a level of commitment I wasn't ready to make, when on all intents and purposes I was making it, but it was psychological. But my point is simply, I think the other key factor here is, are you enjoying it? Because, a lot of times people ask me, particularly people who have been in a large company, given I came out of Google or what have you, Sukhinder, I think I want to go start a company. And I'm like, okay, you're used to a job that has a lot of scale and impact. You are on a track, so to speak, from the last round. Make sure you love it, because it is a 5 or 7 or 10-year journey. And I think there is something actually very right about pausing on all of this as well and just doing a level of introspection about, do you love the journey, really, right? Because I think at a seed level, you're a part of the way in, but you can call it. I mean, angel investors do sign up for a certain level of risk, which is you have to call on whether your company is going to be one of those top 10 or 15, and also whether you have the drive to take it all the way, and whether you love the process of that, because running a startup is a very different thing. So I often think that that seed to A time is also a time to actually just take pause and reflect. Hey, is this for me? Is this for me, right? Because what has the last year told me, A, about the viability of my business, but B, about how much I love the journey itself, because you're not certain about what the outcome's going to be. And I think that is the other important introspection point. And people just presume if you do a seed, you have to do an A. If you do, you know, and I think the seed to A is perhaps the one time where you might have the, you know, if there's ever a point to look at the pause button, I would argue it's seed to A, because once you're A to B and B to C, I mean, it's all on you, right? All right, so I'm going to wrap up and go to the audience and see if we can get some questions.
Hi, my name is Adele. I'm kind of intrigued by the evolution of the funding industry. There's crowdfunding coming onto the landscape. Honestly, the whole area of venture capital is kind of young. And so you talked a bit about convertible notes and your thoughts on that. Can you talk about how you see funding evolving? So we see this Series A crunch to people starting companies. Like, what are some of the options out there, and how do you see your field of financing evolving?
I can speak to it a little bit. So, and this is where I demonstrate some bias early. So we're Investors and Funders Club, which some people may be familiar with. It's Kickstarter-like model where there's some curation on their part, and then basically they'll take accredited investors and sort of bundle them together, similar to if two guys from Band of Angels want to write you a check, they just write a check. But if 20 of them do, they'll bundle a lot up, so you only have one line item on your cap table, which is what Funders Club is doing. So that's one of the models. AngelList is starting to get into this space as well. They're starting to help people with fundraising. So on the crowdfunding side, even without the Jobs Act, I do think that we're starting to get other opportunities so that people can write $1,000, write $5,000 into something that they might not get access to otherwise. I've certainly seen some companies that are going through that, and especially some women-led ones who maybe don't leverage the traditional pathways and club and know how to speak the right language, but have a nice business idea or early traction. I think that's creating some opportunity. I think it's very interesting. I think if and when Jobs Act opens up so anyone can participate, that's going to be another whole level of capital that's available to seed companies. My only caution, again, is going back to don't raise too much money, because I think of it as opportunity cost, what you were talking about, which is, I have friends and I'm like, so if you don't think your options are going to be worth that much, you're losing, jump, leave, go get new options somewhere else because you're missing your vesting time at the new job. Mm-hmm. Right. So that's my only caution on some of crowdfunding, but I do love it. I see some great things coming.
Yeah, I was just going to add one more thing. So I agree. I think crowdfunding's here. It'll stay. It'll be a viable source. We heard in the last panel, Kickstarter, I think, right, was where somebody. But I think the important thing to think about, and I think, Anne, maybe you'd said this at the beginning, is I think still you have to fundamentally think about what is the investor base you want, right? And if all you want is money and you don't want any other affiliations, then that may be a perfectly fine solution. If you think that there are other people who you want around the table to help you from a strategy or other perspective, I think the more traditional sources probably are still more viable for that type of partner.
Got it. Okay, other questions? We've got time for a couple more. Okay, one more.
Hi.
So much for having extra time.
We've seen in the past year the occurrence of some really giant Series A financings, and I wondered if you could speak to that phenomenon, and specifically, what are the potential risks to raising too much money? When is that not a good idea? What business models might not work? When is it not a good idea to raise too much money? How can you judge that?
I think that whatever you raise, you're going to use in 18 months. So just know that, because you'll say to yourself, I'm going to raise $25 million and I'm going to put it in the piggy bank. I've just never seen that happen before. And so it's just sort of a rule of thumb, whatever you raise, you'll use in 18 to 24 months. Do you really want to use that much capital?
Yeah, I think that's right. I would say the way to think about how much to raise, the way we like to think about it is, when you go next into the market, what's your Series B going to look like? What are the milestones that you're going to want to be able to actually tell at that point in time, and then kind of work backwards to Anne's point? So what's the right amount of money do I need for the next 18 to 24 months in order to set myself up for, to be able to tell the best story and show the best progress for that next round of financing?
Right. So you work backwards from milestones, given that your B round is effectively a data-driven round.
Right.
Right.
Yes,
It's a metrics-driven round.
Yep.
Okay. All right. I think we're set to wrap up, so thank you very much.
Thank you.